I'm guessing most of us are financial advisors. There's clearly some guys from the product providers here. But just a show of hands, of the financial advisors in the room, how many use platforms? A good 70%. How many would use managed funds? About the same. What about direct equities? Oh, about the same. And property, direct property? A couple, maybe 10%. And what about ETFs? About 25%. Okay, that's a good sense of where we're coming from. Just bear with me on the technology side. Okay, that's my disclaimer. Please take the time to read it. Right, we've done that. Right, a little bit of background of our journey. I'm second generation in our financial planning practice. Over the last couple of years, we've gone on a journey that has had three main phases. Firstly, on the IT side, our business has moved from traditional platform-based business towards more self-managed super fund and ASX, by that I mean ETFs and direct shares to facilitate that. On the fee side, we've shifted from a percentage of assets and commissions on insurance to purely fixed cost quote provided to the client up front. And on the business management side, our father established the business, and my sister, who is ex-PwC and Macquarie Bank in structured products there, and I are the principals of the business moving forward. So we've been on quite a journey over the last couple of years, in the same way that Brett and Russell have been as well. A little bit about myself. I've got some financial qualifications. My background, predominantly investment banking in London, New York, and Australia. Roles I've held include a sell-side analyst, so I 24/7 used to follow direct equities, day in, day out. I was lucky enough to spend some time both in New York and London, spent some time on the New York Stock Exchange floor, so I get share trading. I love it, I'm passionate about it. I was also lucky enough at one stage to be a property analyst, so I get property, I love it. You can touch it, you can feel it, clients love it. And I also spent some time at Deutsche, including time launching a couple of managed funds. So I get managed funds as well. I can see the benefits to clients, as you do, undoubtedly in this room as well. So if anything, my bias is probably not towards ETFs, it's from those other investing routes. Oops. Right, having said that, our clients love direct share trading. They get home each night, they turn the news on, and there's Alan Kohler telling them the little stories about what's happened during the day on the ASX, and his little graph of the week. They spend their Saturday afternoons at friends' barbecues, exchanging investing stories and how much money they've made or lost on BHP, Rio, so on and so forth. They get share trading, they like it, it's exciting. Having said that, when it actually comes to the share trading, there's a lot of work and administrative hassle involved in that actually adds very little to your overall return. So, clients understand the companies, they see them, they deal with them, they see them on the high street, but there's a lot of extra work, and we as advisors are aware of that. And that's a true cost to our business, and it does nothing to the actual overall returns for the client. So there are weaknesses inherent in that approach. The managed fund side. Now, I'm a simple person, and I, over recent years, have struggled to pick the best performing fund managers year in, year out. I thought, well, let's look at the awards. Who gets the awards? Now, the awards seem to be very highly correlated to past returns in the last year. When you look at the correlation between those awards and then future returns, when you look backwards after the event, the correlation is nowhere nearly as strong. So, in our business, we struggled year in, year out to actually pick those 25% of those funds that would outperform. Plus, they changed. In fact, some studies have shown you're almost better to pick the bottom 25% with reversion to the mean they're going to come back up again. So, there's some of the issues that we faced. I was probably a little bit better at aiming than there, but I did struggle to hit the middle, the sweet spot. So, that leaves us with a question, passive or active? Another hands up. exercise for you. Who's a rugby fan in the audience? Right, about 25%. Who's a rugby league fan in the audience? Ooh, about 35, 40%. Okay. I grew up playing rugby. I went to a rugby school. I played it overseas. West Tigers courses through my veins, through my father, who played for them. So having said that, nearly every rugby league fan that I know detests rugby union. They can't see the attraction in it. And every rugby union fan looks down on rugby league. They can't see the attraction. I'm in the middle where I can see the attraction between both. There are strengths and weaknesses to both approaches to basically how you thump each other with a ball, right? Both have got strengths and weaknesses. So too when it comes to active and passive. The number of active guys that I know that say passive is a dumb game, it's a stupid game. You know, you're wasting money up against the wall. They don't know what they're doing. And the passive guys say, well, active's a waste of time. Yeah, they might outperform, there might be some alpha there, but they capture that alpha with the fees and with the taxes, the excess taxes, because they're trading too often. And the distributions they're throwing off are not tax effective. And when you look at the after-tax returns, then it's not worth it. Now, they're very different arguments, and I can see the strength in both. I don't know which one's right. Do you guys? Does anyone in here know which is the right approach? You'd have to be a brave person to actually claim that. So, having said that, we play it down the middle. We try and take the best of both, take the strengths and weaknesses of both. And I think it's been mentioned by a couple of people already today, and that's core and satellite. We allocate a portion of the portfolio to passive, low-cost, diversified investments. In the past, they were index funds, unlisted. Now, increasingly they're ETFs. And then we overlay that with best of breed, high conviction ideas that we've got. They're not mutually exclusive, and they can gel very, very well together. Just to take a step back, I suppose, about our core, which is a combination typically of cash for liquidity purposes, term deposits, which have been brought up a couple of times already, and ETFs. The way we look at ETFs is as Lego blocks. When you're a kid, remember the old style Lego? Before it all got fancy with Ninjago and Star Wars and all the other tailored Lego that you get today, it was basic Lego blocks. They were all about the same size, and you could build anything. It didn't come with instructions. You had to build one particular thing, and if you lost one piece, the whole thing was ruined. It came with lots of little interchangeable pieces that you could pretty much build anything with. Now, a couple of times today, people have said, well, we had an excellent question earlier. How do you differentiate these guys? Look, sorry, to the product providers in the room, I don't want to differentiate these guys. I want them to be commoditized. I want them to be interchangeable, where I can pick each one up and build a portfolio and have diversity, not just across asset classes, but across providers as well. I won't have 100% State Street or 100% Vanguard, 100% iShares. I want diversification across those guys as well. So increasingly over time, as they compete on price, they do effectively become a commoditized product. And that's in our interests, I would argue. It's also in the interests of people who won't touch an ETF with a barge pole. So, for instance, I'm sure there's some of you guys here who predominantly use managed funds, but you're interested in ETFs. Now, a fair chunk of you are never going to touch ETFs. But I tell you what, ETFs are good for you, because right now, they are forcing down the MERs on those active funds, and they will increasingly do so over coming years. The stats that were given earlier, where they showed ETFs are going to stay similar, and direct equities was going to go up, and managed funds were going to effectively go down. That's going to be the key driver. The MERs on your managed funds are going to have to come down as those guys compete with this. So ETFs are good for you, even if you don't use them. Having said all that, how do we put it in place? Right, in our business, we are simple people, and we like to have simple conversations with our clients. No, we like to have fun conversations with our clients. Keep it interesting. We sit down with them, and we have pretty much 5 phases we go through. We work out our clients' tailored asset allocation, and that's predominantly based on their approach to risk and return. Right? Most clients love having that discussion. It's all about them. Next, we overlay that with our own economic and investment outlook, combined with what the client thinks the economic outlook is. So we get input from them as well. The first thing we do is put in place the defensive portion of the portfolio, in this case, cash and term deposits. Then we expand with the core portion of the portfolio, and then move on to the satellites. Different clients, this can all happen overnight for new clients, or for some clients, they want to stagger into it, so it can be a phased approach as well. Okie dokes. When I think of my kids at the park, I've got an 8-year-old and a 3-year-old. They sit on the seesaw. They're not balanced. One's much bigger than the other. Again, for me, balance means 50-50. So in this case, we've got 50% fixed income, 3% cash. That adds up to 50%. This is an example asset allocation for a balanced investor. It's not the right one. It is just one target asset allocation for one investor. The first thing we do with clients is work out what is their asset allocation, target asset allocation, based on their approach to risk and return. That's a stake in the ground for us. Second thing we do is we work out their defensive portion of the portfolio, the term deposits. Now, we had a couple of questions earlier about term deposits on managed funds. We don't do that. There's no competition on the platform. It just staggers belief that they charge fees, and the rates they give are not comparable with what clients can get elsewhere. So for us, that's our approach. That's not necessarily the right approach, it's just our approach. So we put in place for them a series of rolling term deposits, structured rolling term deposits, typically with a maximum of $240,000, so we get the government guarantee and make sure that it covers the principal and the interest. So that's the first step, the second step after the asset allocation. Then the next thing is now we know the asset allocation, we've got to put in place some products that matches the asset allocation. The first thing with most clients, I'd love if a client came to me, here's $1 million check, it's all cash. What do we do with it? But the vast majority of clients don't do that. They have legacy assets, legacy investments, some of which they want to keep and some of which they should keep. In this example, we had a client who came to us, they had an investment property, they had some fixed income type products that they wanted to retain. They were long investors in Apple, and long had been, and they wanted to keep them, and we were happy for them to keep them, and they've done spectacularly well over the last couple of years. And they'd lived overseas for a fair while in Japan. They'd lived in the Netherlands, so I haven't shown it here, but they have a big portfolio still in Luxembourg, and they have a portfolio also in Hong Kong. So we're in the process of bringing that back and layering that into this as well. So they wanted to keep these assets, and they wanted to keep their platinum. They were long-term platinum investors, and we actually were happy with keeping these investments. There were a lot of investments they wanted to keep that we discussed, and that rationalised that portfolio. So the first thing that we've got to work around is the existing portfolio that they want to keep, and then overlay on that the target asset allocation that we discussed in the last slide. And that leaves us then, well, what can we put in place that matches that asset allocation? So here, we've got 33% in term deposits or cash. There's another slide on the term deposits, which I won't say, so it's not just one term deposit, clearly. And then the fixed income component. We've got diversity across 3 bond ETFs. We've been early adopters of ETFs, both on the equity space and on the fixed income side. These guys are older clients. The client has long asked for an inflation-linked product. We went to the RBA and went through the process of potentially getting them, because you can actually directly buy inflation-linked bonds through the RBA's window, but we didn't do that. When this came on board, the client was more than happy to put a portion into that, because he lived through the 70s, he knows what inflation's about, right? With regards to, they understood bonds. Not all of our clients understand bonds. Bonds are a simple product, but we don't culturally have a tradition of investing in bonds. And then the equity component. Blue chip, diversified, high yield, it's been mentioned a couple of times today, and then overseas. We have a lot of stories or discussions we have with clients. Some clients say to us, look, I don't want to touch China for whatever reason, whether it be political, It could be they already have exposure to China. So having that discussion with clients is an interesting one, and we learn a lot about the clients from that discussion as well. What you'll be able to tell from here is that we've been able to construct a portfolio predominantly with ETFs. And the ironic thing is, when this client first came to us a couple of years ago, they'd never heard of an ETF. It took them a long time to shift towards this type of portfolio. But today, they want to get rid of more and more of the longer investments that they had and shift more into ETFs. Right? It's an education process and it takes time. Does anyone have any questions about this before we move on that they want to throw up? No? Cool. Yeah? Yep, I'll come to that in a couple of minutes, in fact. Okay, so once we put that portfolio into place, we compare it back to the target asset allocation, and also, in this case, we've got 50-50 or close enough, and satellite, core and satellite. You'll notice that we've even got ETFs in satellite investments. By satellite investments, we mean they're not core to the portfolio. It does not mean ETF is all core and active is all satellite, if that makes sense. Yeah? All of this, what's good for us, is it's all part of a conversation that we can have with the client that they get. They understand, and they can have an open conversation and throw their own input into these investments. On an ongoing basis, this for us is an incredible discussion tool that we have with our clients. We compare where we're at with regards to our current asset allocation, where our target is, and what the variance is to the target. And that becomes a large part of our ongoing conversation with clients. And ETFs allow you to shift back to rebalance that on an easy way. Great question earlier about how do we educate the client. The easiest way we found with educating clients was this slide. Clients rank ETFs up there with CFDs, CDOs, and CDSs. Three-letter acronyms that blow their mind. As advisors, we know they're not credit default swaps. They're not collateralized debt obligations, nor are they contracts for difference. You put this slide or a similar in front of them and say, when you get an ETF, you know what? You get these stocks. Do you recognise any of these? You know what? Not only do I recognise some of them, I recognise all of them. Well, not only that, you get all of them, but all the dividends that they pay and all of the the franking credits and the imputation credits, that gets passed through to you as well. They're buying one share. Do you understand? You know how to buy a share. Well, you buy an ETF in the same way on the ASX. Tradable, T+3. They get that. Well, they don't get it straight away, but they get that more so than reading a paragraph about some esoteric three-letter acronym. Does that answer the question? Cool. Some of the other key issues, and again, coming back to having client discussions. That's what makes your relationship with the client stronger, having discussions that they get, that they're intrigued by, that they find interesting. First of all, we had a number of clients in the August, was it 2011, when the market went down about 7% in 2 days. We had a number of our top clients ring up and say, right, I want to take advantage of this. I want to buy. What do I buy? ASX 50, ASX 200. Easy. I made 7% in a day. And they locked out. They sold. So they did lock in a profit. A couple of people have raised issues today about liquidity. A couple of key lessons we've learned. Don't trade in the first hour, last hour, raised earlier. Don't trade when the underlying markets aren't open, so for the international ones. Don't put at limit, don't put at market, put limit prices in. And always look at the spread. A number of times I've gone to do trades and the spread's been too wide. Just don't trade. Wait. The storytelling, the ability to convey to clients simple, what are quite complex investing stories in simple terms that they can understand, that they can relate to, they can ask questions about. ETFs enable that. So whether it be a financials, which people have mentioned, whether it be a high yield, or whether it be a small cap, some clients are taking a contrarian view on Europe. An easy way to do that is via an ETF, emerging markets, consumer staples. Whether you're pro or anti, whether you think they're good now or not, at some stage they're going to be a potential good investment. I've written my sister and I have both written 2 articles, one on ETFs in Eureka Report, the other was on Core and Satellite in Charter magazine. So if anyone's interested in those, connect with me on LinkedIn, and I can send you through a copy. But again, they're written so that clients can understand and advisors can understand as well.